People tend to be familiar with the concept of sales tax as it applies to retail sales of certain tangible personal property and services. In most cases, when you purchase a taxable item or service in your home state, the seller will collect sales tax from you, then remit that amount to the state. Use tax is essentially complementary to sales tax. It's designed to tax certain tangible personal property and services where a corresponding sales tax hasn't been collected and paid, but where those goods or services are consumed or used in state. Situations we most commonly see where businesses might owe use tax are with purchases of taxable property made outside the state. This includes overseas purchases where the buyer did not pay state and local sales taxes. Another common situation is with purchases made over the internet, from catalogs or by phones, from businesses located outside the buyer's home state. What we often see is that a lot of businesses that aren't providing taxable services or products assume sales tax filings are irrelevant to them and unnecessary. We see this with businesses that do not sell tangible property to end users and those that don't provide taxable services. A great example of this is hedge fund management companies that assume the operating expenses of the fund. They will often have use tax exposure. Specific property and services frequently vary from state to state. A general rule of thumb to keep in mind is that tangible personal property such as office supplies, furniture, computer equipment, non-customized software, information services, and repair services are subject to use tax. Here's a few great examples of a situation that could easily lead to significant use tax exposure. A New York-based management company relocates or expands its operations. At the same time, a substantial amount of fixed assets, things like furniture, computers, office equipment, and so forth, are purchased from vendors out of state but used in New York. Providing the seller didn't collect and remit the appropriate sales tax, it's now the responsibility of the company to file a use tax return and remit the appropriate use tax to the state of New York. Here's another typical situation. A Connecticut-based management company hires a New York City-based employment agency to help them fill a position in their Connecticut office. The recruiter successfully places a full-time employee with the Connecticut company and charges a recruiting fee. While the fee is subject to use tax in Connecticut, the New York recruiters may not withhold sales tax. It then becomes the responsibility of the Connecticut company to pay the corresponding use tax on this fee. If you haven't already, make sure to make this best practice a part of your business's operating procedures. Register for sales and use tax in your jurisdiction, and don't forget to file appropriate returns for prospective periods. Only the filing of a sales and use tax return will initiate the running of the statute of limitations for the assessment of the tax, which is generally 3 years. Every business is different. One size doesn't fit all when it comes to use tax. So to find out more about the implications for your business, be sure to talk to your Untracked Early tax advisor to discuss potential solutions for your personal situation. I'm Chris Souza with Untracked Early.